Hey, everybody. August 21st, the market update desk with Scott Riley, NMLS number 157524. Lots of numbers to go over today. In fact, lots of negative numbers. Today's the day we got the annual revision to the total payrolls from the BLS for the preceding 12 months. Now, what did we find from this? We've been prepping everybody. This was going to be a major negative revision. In fact, it's the largest revision since 2009. This is just amazing. So the US economy created 818,000 fewer jobs than originally reported in the 12 months preceding from March to March. Now, this is from the Department of Labor. What does this mean? 818,000 jobs. That is a 30% negative revision. Just think if you were at your job and you were consistently for the last 12 months 30% off your data. Do you think that would be a problem for your employer? But for some reason, this is accepted and it's unfathomable. Not only the US economy relies on this accurate data, but we're the largest economy in the world. And our data, our economy flows through a lot of different things. So it not only affects our market, but it has a geopolitical, geoeconomic impact. 30% revisions. It's just absolutely crazy. So let's kind of go through all these different things. Within these different categories, so I want to go through this stuff here. At the sector level, the biggest downward revision came in professional and business services, where job growth was 358,000 fewer jobs. Now, leisure and hospitality also downward revision, 150,000 jobs. We had talked about these leisure and hospitality, these numbers weren't making sense. We talked about this for months. Now, lo and behold, we were proven correct. Manufacturing, minus 115,000. Trade, transportation, and utilities, minus 104,000. Government was actually upwardly revised about 1,000. And in fact, the categories that showed more growth than what was reported was education and health services, 87,000 more than reported. Transportation and warehousing was up 56,400. And other services were plus 21,000 more than expected. So where is all this going? We got beat up in the market. Home buyers got beat up on interest rates where they should never have gotten beat up on because of this faulty data. When are we going to require and expect more accurate numbers from these? It's crazy how off this is. Just think about that. 818,000. That's in the neighborhood of 65,000 jobs incorrectly reported for each month, 12 months in a row. Where does this leave us when it comes to potential rate decrease when we're going to see that September 18th? In fact, believe it or not, the last three cutting cycles have started with a 0.5% decline, not a 0.25% decline. There's all this talk now of what's it going to be, a quarter or a half. The data is already there historically for the Fed to start at 0.5%. We're going to need to get somewhere between 1.5% and 2% lower than where we are right now for the new nominal or terminal rate. We really do need to start at that 0.5% cut. Now, in addition to this jobs numbers, also the Philly Fed Services Index came out. Showed us a lot within that. Manufacturing's been in a recession for really some time now, but we are also now starting to see a trend of weakening in the services sector. The Philly Fed non-manufacturing index for August was reported at a negative 25.1, which is even more negative than the minus 19 that was in July. So 2 months of really negative numbers. It's the worst reading, in fact, since December of 20, and is the seventh month in the past 8 that has a negative number. Very important information here. Looking to future expectations within this report, the 6-month outlook for services fell by 54 points, and in the last 2 months, from 44.7 in June to a negative 9 in this most recent report. It's a huge swing and a huge change in the outlook for this. The inflation components of this report were pretty benign, and the employment components, as expected, were very weak. Full-time jobs contracted for the second month in a row were negative to a minus 14.9 index, while part-time jobs also declined to an index of 0.5. Mortgage applications, we ramped up really big the week before, but last week did show a little bit of a drop. In fact, purchases were down 5% from the week before, and refinances dropped 15% from the week before. Kind of expected, because we're in this little gray area where rates got super low really fast, came back up a tick, and now we're waiting for all this data to come in, and the Fed comments and decisions, and the PCE report next week. On a technical, one thing happening today, this afternoon, that's very important: 20-year bond auction. We're watching it really tight. As we've talked about, the last couple of them have not been well received in the market. Now, on the technical side, mortgage-backed securities, we've done really well over the last week, and we're bumping up against a resistance level of 100.75. If we can break through that, we've got runway all the way up to 101.5. What does that mean? It means better mortgage rates. On the 10-year Treasury, we have intraday broken below a very important resistance level of 3.8. If we can hold and close below that, in fact, right now we're at 3.79 as I'm looking. If we can hold and close below that, we have a pathway potentially all the way down to, I believe, 3.68. So lots of stuff happening in the market. We got a lot going on between now and Friday. Friday's that linchpin of the week we've talked about with the Jackson Hole Symposium, Chair Powell's speech. Then next week we get PCE. So be ready. These refinance opportunities, these purchase opportunities with great rates, many times are short windows of opportunity, and you need to be ready to seize that opportunity very quickly. We're staying on top of everything for you. Give us a call. We'll help you access these better rates, give you information that can help you make smart financial decisions. Give us a call, 616-293-2189. Scott Riley, the Market Update Desk, your original singular news source for the West Michigan market. Have a great afternoon.